Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, October 16th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following KISS or Dr. Mo, you need to be a client of 42 Macro. So today's key macro question is it time to book gains in gold? Our answer, U.S. Treasury Secretary Scott Bessent, former client, floated the possibility of extending the pause on tariffs for Chinese imports beyond 3 months if Beijing abandons its planned rare earth export controls, with the current 90-day truce set to expire in November. Recall that China recently unveiled rules mandating foreign companies to secure government authorization before shipping products containing even minimal levels of China origin rare earths. We share a consensus view of these maneuvers as strategic posturing before a potential meeting of Presidents Trump and Xi at the Asia-Pacific Economic Cooperation Summit in South Korea later this month. You know who is absolutely loving Trump's trade war? You, because you have more gold in your portfolio than the average central bank thanks to KISS. Gold is surging like Bitcoin used to prior to Wall Street's upside capitulation into the asset class that we correctly forecast a half-decade ago. The price of bullion accelerated past $4,200 an ounce this week, with a gain exceeding 6%. It's truly humbling to know that we were among the first in the world to help our global investor community profit from the gold is better than sovereign debt for proper portfolio construction theme. As someone who grew up in the drug-infested slums of America, fantasizing over the gold chains adorned by my favorite 90s hip-hop artists, I never in a million years thought I would have helped author a theme that led to people, funds, and institutions all over the world panic buying gold. Taking a step back, however, I fear what it means for the outlook for Western societies, particularly the US in particular, if the gold rally doesn't materially correct soon. It's not like gold is an inconsequential asset class in the context of human history. Asked differently, what does a doubling plus of the price of gold in the 25 months since we published our inaugural Investing During a Fourth Turning Regime presentation say about the eventuality of Paradigm D, the print phase of the cut, grow, print sequence required to address the geopolitically driven supply-demand imbalance in the Treasury bond market that we identified in our empirically based fourth turning framework? Whether this fourth turning ends good or bad for America is not something I am smart enough to opine on. What we are smart enough to do here at 42 Macro is help you make and save tons of money throughout this process and in the first turning that will follow it, Lord willing. Transition to our 42 Macro dashboard. As always, we'll wrap up with a question from our community. This one's titled, "Is it time to sell gold?" The message in today's leadoff morning note, I assume, was no, because if it had been yes, it would have shown up in KISS or Dr. Mo. That is correct. The market noise right now is like the noise from Seattle's Hawks Nest, which I'm a big fan of. It's a relentless narrative machine, financial pundits, ex post, and an endless tide of headlines designed to unsettle, distract, and influence decision-making, just like rattled quarterbacks who show up to Seattle, with the exception of Baker Mayfield. Shout out to my man, Josh Wizard, offensive coordinator for the Tampa Bay Buccaneers, one of my best friends, soon to be head coach of the hopefully New York Giants. We'll take Miami. It undermines a disciplined process. This is why I joined 42 Macro, to have a North Star that doesn't respond to the Beastquake. So phenomenal. One, just beautifully written. Obviously, it touches my heart as a huge Seahawks fan. But just taking a step back, I was being interviewed by a reporter earlier today, and one of the first things he asked me is like, should you be responding to the government shutdown or this or that? And I was like, hey, the most important thing you can do as an investor is to learn how to separate signal from noise. The amount of noise that is being produced, particularly in this Trump presidency, with this flood the zone strategy across economic, geopolitical and social policy, is something that is expressly designed to do exactly what he wants you to do, which is overreact and freak out in 1,000 different directions. But there are only 6 things that matter to asset markets on a trend basis. It's growth, inflation, monetary policy, fiscal policy, liquidity, and positioning. 4 of those 5 cycles are moving in an explicitly positive direction when you look out over a 1-year forward time horizon. One of those cycles is moving in the wrong direction, but it will be nullified, in our opinion, by the structural regime change we're going to see in the other cycle, which is monetary policy, overcoming the inflation cycle. And then finally, the positioning cycle is not in a great place. But guess what?
If the other five cycles, not only on a net basis but on an absolute basis, are incredibly robustly positive, then the positioning cycle doesn't matter. It's not a catalyst. Valuation is not a catalyst. Credit spreads are not a catalyst. The AI Bulls Bears survey is not a catalyst. The gross exposure market neutral hedge funds is not a catalyst. The asset allocation of investment advisors is not a catalyst. What's a catalyst is when something goes wrong in one of those cycles or multiple of those cycles enough to freak people out and force them to change their position. And right now, in our opinion, we do not see enough stuff going wrong in those other five cycles on a durable basis to cause a market meltdown. Now, it will eventually come, in our opinion. It'll certainly come. Paradigm C is not going to end well. We know that. There will be a period of time between Paradigm C and Paradigm B that will suck for most investors. Could suck for years, by the way. We've seen plenty of financial crises in the history. But the point I'm trying to make here is that, when it comes to, this narrative machine, particularly around gold now, because it's really starting to pop up. I laughed out loud earlier this week with that Bloomberg article being Wall Street's new trade. I'm like, oh my God, new? The narrative machine around gold is really, really fervent. I mean, you go to Costco, people in line at Costco waiting on those hot dogs are also buying gold. So I'm telling you right now, it's not early in the trade, but in our view, it's not late in the trade either. When you take a multi-year time horizon perspective, if we're right on this paradigm B, C, D sequence, because ultimately we're going to wind up in a place where $4,200 an ounce for gold is going to be very, very, very cheap. So in our opinion, hopefully that doesn't mean something that is incredibly bad for America as an American citizen. Obviously pray that this ends well for everyone, but hopefully my prayers were answered, but they may not be. So it's not my job to enact those outcomes, those policy outcomes, at least not yet. But it is my job to help keep our clients on the right side of market risk. And we're doing that with a phenomenal job with our gold, our Dr. Mo signal here on gold, which has told our clients to be long gold since October of 2023. So thank you to Dr. Mo. And thank you guys for tuning in. We'll catch you back here tomorrow. Have a great day out there. Cheers.